So welcome everyone to our webinar with Guy Allen and Dr. Dan O'Brien. I know it's pretty late for some of you, so thank you for joining us. If you don't already know Guy and Dan, they are both agricultural economists with Kansas State University. Guy's the senior economist for the IGP Institute at Kansas State, and in this role, he facilitates programs in marketing, supply chains, and risk management of agricultural commodities. His extensive career in grains and commodities spanned 3 continents: North America, Australia, Asia, and China. He has vast experience in commodity trading and risk management, supply chain logistics, and commodity analysis, as well as new business development. He also maintains interest in grain production and farming activities in both Australia and the US. Dr. O'Brien's extension and applied research efforts have been in the areas of grain and bioenergy market analysis, with an emphasis on wheat, feed grain, oilseed, and ethanol supply, demand, and prices. He also has been working in the areas of irrigated and dryland cropping systems and natural resource related issues in western Kansas. And he works extensively with agricultural audiences on issues such as farmland leasing and crop enterprise profitability. His current primary focus is on grain market structure, conduct, and performance. Today, Guy and Dan will be discussing disruptions to the supply chain and its impacts on the grain markets, as well as the 2020 corn and sorghum market outlook. With that, Guy, I'm going to turn it over to you for our first presentation.
All right, thank you very much, Kyle, and good morning, good evening to everyone, wherever you may be in what time zone. Kyle gave us a pretty broad topic here this morning, so we're going to try to pack a lot into a short bit of time and leave a lot of time for questions. He's asked me to talk about energy in the livestock sector and sort of the impacts that it's having on the corn and grain prices. I think start off by saying I think the market's sort of getting a double whammy here at the moment. I don't know if double whammy is a technical term, but I'll make it a technical term for this instance. Today, I want to talk a bit about energy. There's 2 components to energy: Russia, Saudi Arabia production, and then the impact of the COVID virus situation. Then I want to turn for a bit to livestock, look briefly at beef, pork, and poultry and the supply chain issues there. The issues for livestock are quite a bit different than the issues for energy. Just want to touch base briefly on the financial and foreign exchange markets. I think they are give us a bit of direction, and also foreign exchange is increasingly important. Look at the energy sector first and have a look at it. This little graphic was put together by my friends at Grow Intelligence. It sort of outlines the situation as it's been developing since March. We've had the COVID situation, which significantly reduced demand. We then have a Russia-Saudi Arabia dispute, and then we have declining demand for gasoline. So that's sort of what we're going to take a bit of a closer look at this morning. Turning initially to the demand side of the equation, demand side of the fundamentals is always a bit harder to define, and it tends to sneak up on us a bit. And I think the market in general across a number of areas is really struggling to define demand and where it's going, and that's where we're going to spend most of my comments this morning. You can see there, first week of March, we saw a significant drop in gasoline demand. That's basically in the wake of the shelter-in-place orders, significant drop in transportation, both road and freight transport, as well as air travel, as people just did not travel or go anywhere. And that's the biggest component of gasoline demand is that automotive travel on that. The good news is this: we've seen it start to recover here as we've moved forward and into May. It reached its lows pretty quick by say into March, and we're starting to see a bit of recovery there. And that directly flows into the ethanol demand situation. Concurrent with that, we've seen a corresponding drop in crude oil prices. This main impact was triggered in the wake of a Russia-Saudi Arabia, call it an economic price war. I don't necessarily like the term price war too much, but with these 2 parties, it was pretty close to what it was, as they couldn't reach an agreement on production. The Saudis just decided they'd flood the market with oil. The Russians thought they would do the same. and prices dropped significantly. As a matter of fact, for that May futures, we saw West Texas Intermediate go negative. Won't talk on that, but it's down significantly. It started to recover a bit. Had we not been in a COVID pandemic with a significant drop in the demand for gasoline, which that dropped probably nearly 50%, the impact of that Saudi-Russia action would not have been as great. It would have been significant, but it wouldn't have been as great. The interesting thing, if you look to the right of the page, you can see the WTI market is now in carry. Having those crude oil markets in a carry situation as opposed to its usual backwardation inverse situation is unusual for the oil markets. But if they're going to store it, they store it in the ground. It seems like they got educated real quick on the delivery mechanism and the value of space. So that significant impact underlying the ethanol situation. This is just a quick of when the oil went negative on that. When crude oil drops and energy drops, commodity prices drop. And this is comparing the WTI crude oil with Chicago corn. I've gotten so over the last 20 years, when I'd get up in the morning, the first thing I'd look at was the corresponding exchange rate and the domicile I was at. The second thing I'd look at was what was the energy price doing. Energy has such a prevailing influence on commodity prices these days, both corn and soybeans, and we can see the corresponding drop on corn. The thing that's a bit disappointing is we've seen not an insignificant recovery in the oil prices. It's come back up off its lows. We have not seen the same response in the corn and sorghum markets yet, but need to be a bit more optimistic, I think. The other corresponding issue that's lingering in the corn is the livestock situation, which we'll go through here in a minute. This just highlights sort of the demand destruction we've seen for fuel. As you can see on the chart on the left, that's sort of the historical numbers, and as I said, we've lost about 50% of that demand at its low, which is just a significant disruption to the market. But we've seen that start to come back, and I know we've all seen it at the pump. The ethanol sector was quite quick to shutter and shut down their facilities. I think they shut down close to half, 40% anyways for sure, and then it was approaching 50. The impact, it was about 322,000 metric tons a day on DDG production. And I think DDG production is important because it is a significant export, but I think the export buyers were still there, particularly Mexico and China. And we saw that demand then switch to alternative grains. I think something that's really lending support to grain sorghum at the moment is that nearby drop in DDG production and the fact that it's not necessarily available at the moment. This is translating that ethanol production into the daily grind for corn and grain sorghum. We saw that drop again by about 50%, where we went from about 110 million bushels a week down to about 55 million bushels a week. We're starting to see that come back slowly. One thing I'm picking up this week, there is a profitable margin in ethanol at the moment, and we do have some ethanol producers actually putting hedges out for fourth quarter this year, which is making me a bit more optimistic that we're going to see some recovery in that. If you would have talked to me a week ago, I probably would have had a completely different flavor on this situation. As I said, we haven't seen the response in corn. One thing I think I always look at is basis. An old Kansas State graduate who mentored me 30 years ago in Kansas City used to say, cash leads futures. We saw that significant drop in basis, particularly in that Iowa corn market, and we just aren't quite recovering from that yet, as the demand's just not coming there to have. Looking at yesterday's EIA report, this is their short-term forecast for West Texas Intermediate. They're actually quite optimistic. Talking to some people in the energy side, they think maybe they're a bit more overly optimistic than what some of the private trade are, at least the guy I was speaking to. But it does give me some encouragement as that blue line moves forward, that we'll continue to see some good support for domestic crude oil, WTI, which that's what the ethanol market tends to follow. And we should see that demand from the ethanol sector come back, particularly third and fourth quarter. One thing I'm going to let Dan talk to a bit, but I kind of quick and dirty back of the envelope tried to pencil how many corn acres does that mean, and I've sort of got a range of numbers, but I'm sort of calculating for every 1% drop in ethanol demand, we see about a 340,000 acre drop in the need for acres. And the question I think Dan and I have been scratching our head is, is the farmer going to react to these price moves? Last year we did see the farmer was quite sensitive to the corn bean price ratio and continued to plant corn. USDA yesterday didn't seem to indicate that. I was a bit surprised. I'll let Dan expand on that a bit when we get to him. Did you want to make a comment here, Dan, or do you want to wait?
Yeah, I think that farmers have they're farming the safety net right now, and what the USDA came out with, and I won't go too far on this because I'll still get into your time, but they could have come out just as easily in that supply demand balance sheet and had 500 million to a billion less bushels of corn used in ethanol, but they came back at about 5.2, and that makes all the difference between prices where they were at around $3, $3.20, something like that, versus getting to 250, 270, et cetera. So it's a kind of a billion bushel swing. So they're banking on recovery in the ethanol industry, and that puts prices at $3. And when you look at where the safety net is for crop insurance, for the farm program, and you do the adjustments on their deductibles that the government has, that's surprisingly just about where the safety net starts to kick in, about $3.20.
Yeah. All right. Thanks. Thank you, Dan. Moving on to the livestock sector. Livestock sector is a bit more complicated. It basically precipitated, again, from the shelter in place, from the COVID pandemic and reactions to that. And what we've seen is a significant change in demand patterns in meat. The key thing, I think, when we talk about meat, you can't, beef isn't beef. You have to break the meat down into particular cuts. For instance, Americans like to eat hamburger and steak, and a lot of the rest of it we export. We export a lot of the grain-fed beef, and we're a significant importer of grass-fed beef for the hamburger market. I'll give you an example of that here in a bit. Also, the fresh versus the frozen situation, big shift in retail versus food service. For instance, as the universities shut down, restaurants shut down, food service situation is really, really shut down, and people now are eating more at home, so they're going more than.
Are we still going?
The grocery store, out to an international situation. I think it's important to keep in mind the U.S. consumer eats out more than any other consumer in the world internationally. Also, retailers' various approaches have varied. Some restaurants have shut down. Some are curbside takeaway. It's just really hard to quantify. I talked a bit about change in cuts, and I'm going to use the pork situation here to highlight that. If you look at the brown line there, the brown line is pork belly, i.e. bacon. We saw that, and you can see to the left of the chart sort of the more normal spreads between the cuts. We saw the value of pork belly drop to be the cheapest cut there in early April. Interesting thing, the supply chain, meat supply chain had been running over 100% capacity with strong exports. Cold stores were full. Things were happening. Pork belly today is the most expensive cut. So this swing in the value of the cutout of any particular carcass is fairly significant and has been quite variable, making it a real challenge for various people. Your meat analysts, they go into the demand by cut situation. So as I said, beef's not beef, pork's not pork. You have to break it down into its parts. But I think this just highlights that. The other contrast that is ham, and I noticed in the grocery store ham's pretty cheap. I got it for less than $2 a pound this week, so my freezer's full of ham on that. It's now the cheapest cut, so quite interesting. The challenge in the meat supply chain is the bottleneck post-farm gate. There's plenty of supply. It's just availability at the retail level. That challenge, that bottleneck is at the processing plant for slaughter and further processing. As the COVID situation has shut those down, as labor capacity is being limited, some plants have shut down totally. Even when they gear back up, they're not running at 100% capacity because of precautions they've put into place. So they're running 80-85% of capacity. So that's been the bottleneck. So it's quite a different situation than the ethanol situation, which was at the processing or the production side of the supply chain. This is sort of trying to quantify. The graph on the left is the slaughter, weekly slaughter for cattle. The one on the right is hogs. We've seen probably anywhere from a 30 to 40% drop in the cattle and the hog situation, and this continues to change. And I think we're starting to see a recovery on this. This graph's probably a week old. I think we're starting to make improvement on this. How fast it's going to recover? Look, there's a lot of cattle backed up. I think approaching 1 million head of cattle backed up, and they're at heavier weights waiting to be slaughtered. The pig situation, some of those have been taken out of the supply chain at a younger age, but again, they're heavier weights. The good thing from a grain point of view is they're still eating. They're eating a heavier weight. They're eating a lot of feed. So demand from the feed sector has been pretty good. Forecast looking forward, I'll go down to the bottom points. The outlook for beef production is down for the second quarter, 13% year on year, but back up for third quarter and up for fourth quarter. And the production for beef will, for this 2020, I think will exceed next year, or sorry, exceed last year. So it's still fairly optimistic, and we're seeing very good, strong export demand as well as domestic demand. The good thing is Americans still, they like to eat their meat. Pork situation, not too much different. The focus has been on this COVID situation. I think one thing I want to highlight here, let's not forget the African swine fever situation, particularly with China and Asia. That's really what's driving the demand for animal protein as those populations and consumers replace that with a variety of imported meat. You know, it's estimated we've lost a third of the world's pigs. It's reportedly under control. I say that with a bit of skepticism. How soon that sector will be recovering is probably the big question. I think it's going to be 3 to 5 years rather than a matter of months. But that is providing strong underlying demand for meat in particularly China and Southeast Asia. Poultry weathered the storm a bit better. We saw a drop of about 10 to 12%. Poultry has the capacity to respond quicker, shorter growth rate in the broiler sector. 34 days to get a chicken from hatch to market, 21 days to hatch it. So 60 days, they can respond pretty quick. And that's starting to make a bit of recovery. Just to highlight it, I remain pretty optimistic on the meat sector. We've got some hiccups in the road. We're working through the processing situation. Look, the demand's still strong for meat, i.e., and then for the feed grains. There's good, strong export demand. And, the question is going to be how fast, what's the recovery going to be at the processing side? And then I think it raises a number of supply chain and social issues that I think we as the public are going to have to address. And as an industry, we need to be, I think, on the front foot of that. Talking to my colleague here at Kansas State, Glenn Tonser, he's fairly optimistic the meat production is going to exceed last year's level and the feed demand is going to remain strong, particularly in the second half of the year. Quickly, just last two slides, I want to touch base on the general economy. The question comes, how fast the recovery are we going to see? I was fairly pessimistic, particularly with a, double-digit 14% unemployment rate. That's probably likely to go higher. And that directly impacts demand on a lot of our products, both ethanol and food. You look at the stock markets, Standards & Poor's and NASDAQ, we're seeing this very strong V-shaped recovery, 50% on Standards & Poor, 80% retracement on NASDAQ. I've learned over the last 35 years, you don't discount the smart money in the marketplace. They usually don't get it too wrong. But this here keeps me very, very encouraged that we're going to see a fairly quick recovery on things. We're already seeing it in the gasoline and travel demand. So I think, that this has a good, strong indicator that a reason to be optimistic. The other thing I like to look at every day is foreign exchange rates. One thing that I think you guys are quite plugged into is the exchange rate in your particular region and country. The U.S. dollar is very, very strong in spite of this spending we're seeing federally. We're spending money like a drunken sailor. The U.S. dollar is still strong. It's still the safe haven. On the right, I've got the graph for the Mexican peso and the Brazilian real. And look, they're at historical cheap levels. So from an export side of things, look, it's making our commodities look very, very expensive to our overseas customers. And we need to keep that in mind. And one thing I'm really trying to focus on from a risk management point of view is managing that foreign exchange risk as much as we manage the commodity risk. So those are my comments there. Happy to answer questions when we get to it. So thank you. I'll kick it over to Dan.
Thanks, Guy.
Yeah. Hey, Kyle, how would you like me to map out this? Map out my part. What's your time frame, and what would ideally hit you for?
I was going to suggest if you could just focus on your corn data and just spend about 10 minutes or so going through that, and then we'll open it up for questions for everybody.
Sounds good. Okay, let's see here. This will stop their sharing. Okay.
Am I off? I've just yeah. There you go.
Just a minute here. All right, let's see. And now I need to all right. We'll start with the end from the beginning. You see the www.agmanager.info web address there. Both Guy and myself put AgEcon information on there, and we tried to be aggressive at Kansas State with our info. In fact, tonight I've got a webinar going out talking about the in-depth, well, moderately in-depth in 30 minutes, the supply-demand prospects that have come out of Tuesday's USDA supply-demand report. So anyway, you've got we're trying to be proactive in what we're doing on the grain side. I just want to address again what Kyle and Guy and I had talked about at the very get-go of our discussions of what to talk here, and that would be how the acreage numbers coming out of the USDA and what may come about eventually, how that could affect the corn supply-demand balance sheet. And of course, from your point of view, you're interested in exportable supplies and the price that it would go out at. So take a quick look at corn markets, and some of these, I think you all have this presentation. You can see how prices have dropped off. That's no surprise to anybody. There's our normal seasonal pattern, and starting with the September through August marketing year, and we didn't know, in hindsight, we didn't know we had it so well up until the COVID-19 issue hit the economy. And then this corn supply demand balance sheet came out from the USDA. That was released Tuesday, and you can see the number that stands out to me there that as we mentioned earlier, Guy brought up on the demand side, ethanol usage. Note that they dropped that 100 million bushels in the from April to signify what's happening in the short run here, but then gave a 5.2 billion production estimate for the coming year. So, Guy, they're clearly banking on what you talked about in terms of a recovery. Now, I had gone through this, and just like Guy, about 2 weeks ago, or about a week ago, did a set of supply demand balance sheets, plugged in for that 2020-21 number, basically $1 billion less, and it makes all the difference. Instead of that you're looking at close to 4 billion ending stocks to use 25, heading for 30. And basically, you're dancing. If you're above the loan rate, you're thankful in a situation like that. So there's a lot riding on all of this. And in terms of the USDA's projection, they did show they're projecting that ending stocks will jump, but stocks to use at 22%, a 320 price. And acreage is a big issue. And I know my good friend, I guess I call him a good friend. And you shouldn't call me a good friend until I give you bad info. Okay, then you can do whatever you want. Anyway, but the expectations are that as the corn market dropped off during planting season, that the general market talk was that, gosh, we'd see acreage drop, and that, the prospective plantings number came out at the end of March, just a hair under 97 million acres, 96.99, and talk amongst very respected analysts, gosh, is that 92? Is it 93? Is it 94, 95 million acres? Well, what's happened since then, since that prospective plantings report came out at the end of March, is that we've had great planting weather and really not many other good I guess opportunities in terms of places to go. Soybeans are doing just so price-wise, not as bad as corn, but I think what occurred is that, again, about a week ago, at least I can relate my train of thought. So I put out this analysis through Ag Manager and projected basically, gosh, it looks like if we take ethanol usage down and actually hold feed usage and exports about the same, to what USDA was thinking coming out of their Ag Outlook conference, that, again, we were looking at national loan rate $2.20 a bushel up to 250, 270. So the so obviously market prospects are pretty bad, but then so it felt so bad about that that I came back in the next few days and looked at the corn safety net. The corn safety net really isn't the loan rate is there, but you have crop insurance, $3.88 per bushel planting price for revenue coverage for crop insurance to cover pre-harvest to harvest moves, post-harvest $3.70 for the reference price. So I'm not the only one saying this. People I respect are saying, gosh, in markets that could go anywhere and almost none of them good, given what farmers were seeing when they were on the tractors planting, they went to their safety net. So maybe the key issue is if a lot of times if there's a problem in planting, we'll hear the seed dealers, some from the seed industry talking about, gosh, we're getting a lot of seed turned back, nothing's happening. Crickets, nothing happening there. So it still seems judicious in light of what's been occurring to think there'll be some cutback, but information we're getting now, I think you mitigate that a little bit. And so I'm showing about 1.5 million acres less, and but we won't have a verification until the USDA acreage report at the end of June. So my thoughts were, if they're going to change it, I wish they'd just change it and not just leave us hanging on this critter. So anyway, so we'll wonder where we're going. Corn yields. You can see the USDA's projection of 178.5 bushels per acre. That's a record yield. And production, again, so here, when you're talking to customers, you wonder, does it look like the U.S. is going to be short of grain? Not with 95 to 97 million acres planted, record yields. You're heading towards, those numbers are heading towards 16 million bushels production. And let's say they cut that back. And I think it's probably more reasonable to think of 174. You know, it's kind of dry out in areas. Even with that, you're looking at, well, you're looking at something over north of 14 billion. Now, we could get a drought, and there are talks about transitions to La Nina and all that stuff. But, you know, it's just a challenge to figure out exactly where all this is, where those things are at. The judicious thing at this time is to plan on something in the neighborhood of normal production and large ending stocks. I've got information here, and Guy, this just supports what you were doing. You guys can look at that. Exports, this is where you're at, no doubt. Just interesting to me in tracking weekly exports, and there's be some new numbers out here to update this. Exports for corn have been moving at a regular pace here about the last, or good pace, last 3 or 4 weeks, but they sure started out slow. And Guy, that's in spite of what's been happening on the exchange rate. Interesting. So here's maybe the last thing I'll do in the interest of time, and then just say the rest of that stuff's out there. So here you got the USDA's 2019-20 projection, and there's their 360 at the bottom of that first column. 55 some days of stocks, 50% stocks to use. The USDA is right out of the gate. Projection for this year on Tuesday's report. There you can see $3.20. And note that I have been chastised and have fallen in line. Guy, courage is a hard commodity to find, you know. So anyway, so my original numbers on that ethanol deal were 4.25 billion bushels. You take 4.25 billion bushels, add that, ceteris paribus, everything else the same. Add that on the bottom, you're dancing over 3 billion bushels, and basically you're at the loan rate. So I think for the market, so much is going to depend on that. The U.S. economy recovery, ethanol demand moving up, and but for the selling side, for exports, that'd be low prices. You know, it'd be a great thing for our competitive pricing situation. But for the U.S. corn farmer, they would grumble and grouse about it. But right now, what the USDA has put at that 320, 335, those numbers are just about 10, 15, 20 cents over where the effective safety net starts to kick in anyway. So basically, we're at the effective safety net. We're way over the loan rate, you know, nationally at 220. Kyle, I've got a bunch of other things there, but I think everybody has that slide deck, and if they want to, well, I think I'll stop share on this. If someone sees something back in there they want me to go after, or a question leads us there, then I'll hop back in. Okay. Okay, Kyle, it's all yours.
Yeah. Thanks, Dan. Great information. I will make sure that everybody has copies of both sets of slides. That way they have all the information. But at this time, if you have any questions, any and all questions for Guy or Dan, please ask away. Reese tells me that they are almost impossible to stump. So I think if you have a question, they'll be able to answer it.
A question for Guy. This is Javier Chavez from the Mexico office. Last year, we saw some corn move from South America to Mexico, that even made it to the United States.
Yes.
With all these logistical things going with, I mean, costs on freights, do you see that we might see again South America corn move to Mexico? What is your opinion?
Look, it's probably not. I guess I'm increasingly skeptical on that. The good news for the bulk export situation is the export supply chain does not seem to be having any problems at all. It's running smoothly, particularly out of the U.S. I know.
Looks like we might have lost Guy's connection for a second here.
That to some extent. So I don't, you know, it's a relative value situation, and it was, I think, a gut slot harvest situation that brought that corn into Mexico last year. I don't see that happening this year. Could be wrong. By contrast, though, I will highlight the container market is seeing some disruption. You put a variety of products in the containers, and it's really changing their backhaul situation, their logistics, and getting particular product into place. We're seeing that particularly in meat, where they require refrigerated containers, but we're also seeing that with bulk graining containers, as those containers are used for a lot of different things. There's not a lot of product coming into China, coming out of China, and Asia, so it's hard to get stuff back in there, and there's been a significant disruption in that intermodal transportation situation.
There's a follow-up question with that, what you're mentioning. We actually have seen significant prices of DDGs falling down into the Mexico market. Is that due because they cannot move containerized DDGs to the Asian market, and that's why there's an oversupply of DDGs?
I don't think there's an oversupply of DDG at the moment. I don't know. I don't know. I'm surprised you tell me that, because there's been the FOB basis or delivered in CNF basis for DDGs is quite high, or for sorghum is quite high at the moment. DDGs, I'm not quite across that, Javier, so I'm not quite sure, but I'm assuming that DDG market's pretty tight with 40% shutdown of your ethanol situation. So I'm not quite sure.
Just to add to that, the DDG situation is improving, but that balance sheet in the nearby is pretty tight. People are having a hard time selling, just prices too high in the nearby.
When the ethanol plants started to shut down, and Guy, this is my understanding, the dairy industry in particular was anxious to not have their feed rations messed up, and they used quite a bit of DDGs, so that jumped in and had some effect on jumping DDG prices. Also, when you drop back ethanol usage, as you scale back DDG production, and you still have these livestock feed rations out there, and so part of the USDA's jump up in feed usage for corn had to do with corn coming back into livestock feed rations for the affected species and resubstituting back in. So it's kind of that May report, or the April report was really a big issue in that total corn and grain sorghum together jumped about, feed usage jumped about 195, 200 million bushels, and ethanol production dropped back, but you put DDG's algebra within that, and almost all the increase in feed usage that happened in corn you could say was probably an offset for just compensating for DDGs no longer being available in those rations.
Thank you very much, Dan. Muchas gracias, Guy.
Thanks.
Hey, Dan, this is Reese. I had a quick question, or maybe a point of clarification, if you could provide it. Some of our folks are not super familiar with a lot of the farm programs, just being not U.S. nationals. Can you briefly explain, when you talk about your safety net and you talk about PLC at 388, and you talk about a safety net around 320, can you just really briefly explain exactly what you mean there, so folks are fully in tune?
Yeah. Yes. In fact, I'm going to hop into Ag Manager, and we put together a tape and a video on that. So hang on, you guys. I'm going to go there real quick. Or I hope to. Let's see if I can pull this off. Right. So here's our Ag Manager website, as you can see, and on this we have a front page where you can see where our scrolling set of issues that we deal with are coming in. And you take note, just as Guy was talking about, man, we have a lot of concern about the livestock industry right now. And you can see a lot of what's put out in the last several days have been there. Let's see here. As I go down, Weekly Grain Outlook Interactive. Okay, Price Protect. Monty Vanderveer and myself put together a video just explaining where the safety net comes in. And basically what you have, and there's a paper that goes along with this, what you have is our crop insurance coverage, which is based on futures and their local farm yield largely. And so that covers price changes in corn and harvest corn futures, Dees corn, November soybeans, from an average in February pre-plant to well, for corn it'd go through November. So that covers the price changes in futures. So if futures prices go down, then that's, there's an income, a farm yield times price change coverage there. So at $3.88 futures is we thought when that happened for the average of December corn 2020 in the month of February, I thought, well, gosh, 388, that's pretty low compared to where we've been. Well, now that's gold. That 388 is way better than 330 at where we've fallen to. So you have that. Then you have, once we grow the crop, if there aren't good market prospects, we have what we call the marketing loan, and that's that $2.20 cash price. So farmers can put their crop into the marketing loan, and it'll give them some bottom-side price protection cash flow. And then you're going through time here, and then we have for the marketing year in the U.S. farm programs, there's something called ARC, Ag Revenue Coverage, and PLC, Price Loss Coverage. If you're talking about U.S. agriculture and farm programs, you have to know acronyms. Just realize your minor in college is in acronyms. Anyway, the point is that it sets a floor for coverage of about $3.70. So here you have, and that's not determined until the end of the marketing year. So you have pre-harvest coverage, harvest coverage, post-harvest coverage, and so when we're talking about that safety net, that's where we're getting at. Reese, is that what you're referring to?
That's perfect. That's probably, I think it gives people sort of an idea of exactly what you're talking about when it comes to some of these programs.
Yes, like I say, we have this explanation. I and my colleague Monty Vandeveer, and there's a paper that goes with it for corn and for soybeans. I've seen some on your chat, some talk about Brazil. Guy, I'm going to create a hand grenade, then I'm going to throw it on your plate. Okay? Here comes. The COVID-19 impacts have affected the supply chains and the populations of these countries. And it's a surprise to me that we haven't had more disruption at the ports and in moving grain through the country, et cetera. In fact, I think that's our long-term competitive advantage, in that we have a fairly mechanized grain movement system to where we're not vulnerable. But Brazil, Argentina, they're trucking grain out of the interior largely, and so I guess it's the battle of COVID-19 disruptions versus, for Brazil, a very, very poorly functioning currency that really helps them to be competitive. But so I've wondered in this coming year if the things that will surprise us will be the COVID-19 disruptions that happen in local supply chains and the pull of these countries to, given how at risk these supply chains are, to build up their own domestic stocks. What do you think of that, Guy?
Yeah, no, look, that's a very good point, and I didn't touch base on it, but a key situation here is a lot of these countries are increasing their food safety reserves, and that's probably more evident in wheat and rice and your food grains than your feed grains. But we saw China buy corn last week, probably because it was a good price, but also I think to replenish their stocks. But as these countries build their stocks inventory, that's temporarily taking it off the market. So it's going to show good nearby demand, and it's going to be interesting how that evolution evolves. About 2 years ago, I said to a colleague looking at a long-term cycle in the price in the commodity cycle, we're at a point where we should see strong government subsidies, stocks buildings come in. I said, I don't know what form they're going to take, but I said, this is where we're at in the big picture commodity cycle. Well, sitting here today, and that's what we're talking about. So yeah, I think it's going to be interesting in the next 12, 18 months as socially each country has that conversation and how they're going to approach it. It could be quite different between countries. We're going back to 1980s sort of discussion on that, early 90s. And that's going to potentially change the, I guess, the flavor of the commodity markets for the next 10 to 12 years. Your supply chain disruptions, yeah, I think was well taken. The bulk commodity side of things is pretty automated, not very labor intense. You know, it's not like a meat packing plant where you're standing right next to your colleagues on the processing line. So it works pretty smooth. I've been surprised we haven't seen more disruptions on the receiving side. But again, most of these countries are pretty modern and automated. We've seen a bit of it in the container side of things. Where I'm sort of looking for it is further down in the first stage processing, similar to what we're seeing in meat, and had a discussion last week on the wheat, on the flour side of things. But a lot of these mills they're pretty automated these days. So I think that's a big advantage, and people have been adjusting to that. But I think you're exactly right. It's going to be one of those issues that's going to potentially sneak up on us. We have been able to react to those changes fairly quickly, though.
I could see spot, surprise, unanticipated demands come in. Is what I'm wondering about. But how do you know when a country gets tight?
It's those unknown unknowns that tend to hurt you. So yeah, it's and I think the U.S. And the EU, they've got significantly different approaches, and both answers or approaches can be right. But I think there's a lot of places that are picking up and learning on the back of that. And I think that diversity of approaches, particularly in an unknown situation, is probably good. You don't have all your eggs in one basket, and it diversifies your risk across the demand sector quite a bit.
Kyle, Reese, I'd be remiss. I'm in Kansas. We're in Kansas. We did mention grain sorghum. Strong, some pretty strong spike basis bids happening in central Kansas I assume to fill trains for grain sorghum. And you hear rumors of this, etc. So I need verification. But the change of policy in China to apparently want to pull in sorghum now is that allows sorghum to distinguish itself from corn. In the supply demand balance sheet, you saw slashing away with a machete at grain sorghum feed usage and ethanol usage, socking numbers higher into grain sorghum. So it's a risky way to live, but welcome to grain sorghum in Kansas.
Yeah, just to echo that, I got to be pretty optimistic grain sorghum at the moment because it's filling that DDG void with that drop in production, and on the back of that into some of those non-GMO type markets. And China particularly has been the big driver here lately. Again, as they're trying to rebuild their stocks, as they're moving forward quite. I got to stay optimistic on their ability to meet their trade commitments on this phase one deal. And they've been in the market pretty consistently for corn and beans and sorghum and a number of commodities. So I think you've got to be increasingly optimistic they're going to meet those trade commitments, or at least get pretty close to them, even in spite of the COVID situation.
And here's a question where we need to ask you guys. I hear that in China, they go back and forth. Are they going to go a market route and whittle down their stocks, or are they going to build up stocks? So here they were probably, with Chairman Xi, for a while they were whittling down their corn stocks, and other grain stocks. But now COVID-19's hit. It sounds like they have swung to stock building again, and that's a big deal. Is this what you're hearing too? I hear that of rumors and anecdotal ideas, but their actions in the market is that they're buying. But what are you hearing?
I see Brian Lomar's on here. I might put him on the spot if he's paying attention. Brian, you got a view on that?
Hi, Guy and Dan. Yeah, I am on the line. The short answer is there are two different stocks. The stocks that everyone's been talking about the last 5-7 years are the what were called temporary reserves that were built up in 2013, 14, 15 crop production years. And then they ended that program in 2016 after buying a lot of 2015 corn, and then have been drawing down those temporary reserves in Northeast China. The stocks that China wants to build up now are the strategic reserves, which are held, the temporary reserves are all held in Northeast China. The strategic reserves are held near cities throughout the demand areas in southern central China. And those are a lot smaller. So yeah, they're talking about building up stocks. Whether that happens or not, I think it's more than 50% chance that they will. But it's not like it's the apples and oranges to some extent. But yeah, not only are they building up stocks, but they've also essentially reversed all the programs that were established in 2016 to reduce corn sown area, reduce corn production, expand soybeans in order to draw down corn stocks. Those have been reversed now. So clearly we're back in a market where China is concerned about the amount of corn.
And what are they doing with their, there was basically, it was announced they were going to move towards an ethanol program, almost copycat of what the U.S. was doing, 10% blends. Has that stopped also or been delayed?
Well, which do you mean? You mean in the early 2000s or just recently?
Yeah, more. I guess more recently.
They're slowing it down.
Okay.
They're slowing it down. There's some provincial resistance. They have not made an announcement that they're not going to pursue that anymore, but they're slowing it down. And I'm sure a lot of the same thing happened in the early 2000s, mid 2000s, where they had ambitious plans to expand ethanol, and then they slowed it down when they realized that they didn't have as much corn as they thought they had. And an almost identical thing happened this time.
You know what?
But right now there is more support for ethanol because it's renewable, because it has environmental benefits, and yada yada yada. So I'm still optimistic that they will pursue an ethanol program of some sort.
Guy, I heard a new term, provincial resistance. I think that describes Kansas pretty well, doesn't it? Provincial resistance.
That similar approach we probably
right.
Like a regional U.S. Look, while we're on China and grains, I will mention there's an interesting barley situation evolving in Australia. China's threatened to put an 80% tariff on their barley imports, which about 3/4 of Australia's barley production does go to China. If that and that's in response to their political position, particularly on this World Health Organization. Australia seems to be the group that's pushing that issue to address that with China. That's fairly significant demand potential. Total world barley planted acres and production is estimated to be down. So just if you're talking to your barley producers, for those of you that have barley producers, that is lending support to the barley market, and I'd watch that situation as it evolves between China and Australia pretty close for some indicative numbers on that.
Yeah, Dan, we had another question in the chat from Hogs. It says, what will be the biggest risk, including weather, that will impact on corn quality and yield until harvest this year?
Well, I think you're, let me see. Yeah, Haksu, I think your intuition is right on. It's kind of a weather issue right now. As far as quality goes, so often that has to do with harvest weather. Are we delayed with grain sitting in the field or not? Now, the USDA has still going to resurvey again up in some of the northern states where corn was still in the field, and we saw social media is a great thing. You see farmers showing videos of them harvesting corn in the middle of 6 to 9 inches of snow all through the winter months. So I think that I hope I have an accurate perspective to tell you. I think that will be for the 2020 crop. I think we'll focus in on that as we get into the harvest months, and if we start to get delayed harvest, then all these issues of aflatoxin or other things that will come into the focus. I think more as we head off into September, October. Right now we're assuming, maybe it's Pollyanna, but we're assuming it'll be a great crop. We're assuming good until we get on the fringes, and frankly, we'll have enough carryover stocks that when we do get poor quality, that you wonder, well, what are these farmers going to do? Well, they'll do what they always do. They'll hold it back, and they'll wait for some better grain to come in, and they'll try to blend it off. Anything to avoid just destroying it or getting rid of it. So that's how I generally approach that issue.
Are there any other questions for Guy or Dan?
Well, I would say it's a pleasure to speak with you folks, and IGP, KSU AgriCon have a great partnership, and we're Guy and I are going to make sure we exploit that. I really appreciate Guy's international perspectives and experience. It just adds a lot to what we're trying to accomplish.
Yes, thank you very much for the opportunity, and don't hesitate to give Dan or myself a call whenever you want to have a chat about something. It's always enjoy talking to you guys out in the field to get some on ground, see what you're seeing on the cold face, because sometimes it's different than what we're seeing here in the ivory towers. So always welcome a call.